Hey everyone, welcome back to the Nadlan Forum Podcast Daily. Lior here with you. If you've tuned in before, you know we're always hunting for ways to make real estate investing smarter, faster, just a bit less stressful, right? So today's topic, I gotta say, I wish I knew about this I don't know, 10 years ago when I first started dealing with gut rehabs and trying to juggle multiple loans and different closings. Anyway, we're diving into Rehab-to-Perm loans, or R2P if you like acronyms. If you're just hearing about these for the first time, don't worry. I had to Google them the first time too. Basically, these are loans designed specifically for investors looking to buy, renovate, and then hold a property, like for rental income, all with a single financing solution. Sound good so far? So, here's how it works. And honestly, the structure is elegant. You have two phases in one loan. First, there's the rehab or construction phase. That's where you get funds advanced to buy the property and cover your renovation costs. Then, once everything's finished and the property is stabilized, it passes all those lovely inspections. The loan just rolls into a long-term permanent mortgage. And the key thing here, it's automatic. You're not refinancing, you're not reapplying, you're not praying that mortgage rates don't shoot up in 6 months. What I particularly like, and again, I learned this the hard way, is that you get one closing. You do the paperwork once, pay fees once, and from day one, you lock in your permanent mortgage rate. So you're actually shielding yourself against that future rate roulette we talked about in the last few episodes. Back then, I did the acquisition loan, then a separate construction loan, then I'd spend weeks scrambling to refi when rates were climbing, hoping my property would appraise high enough. Total headache. With Rehab-to-Perm, you avoid all that. So if you're sitting on a property you know needs work, but you want to hold onto it afterwards, this is the type of loan you want to look at. Let's dig in with a real-world example, because the numbers always tell the story best, right? So, there was a recent deal on Market Street in Algonac, Michigan. A single-family investment property. After repair value was pegged at $180,000. The investor grabbed it for $100,000, put together a renovation budget of around $80,000. Now, with a loan amount of $75,000, the lender's loan to value was 65%, loan to base is 70%. Not bad, shows the investor was bringing real equity, but also that this wasn't a totally high-risk deal for the lender. Now, here's where R2P structure really shines. The permanent rate was locked at 8.5% fixed. Construction rate at 12%. Term, full 30-year amortization, that's 360 months. The construction period was 6 months, 180 days. At closing, the borrower got up to $70,000 upfront, while $5,000 was held in escrow. This is for the reimbursement draws as work gets completed, which, by the way, the lender will only release after an inspection. So you actually get that extra layer of protection, making sure work's done before more cash comes out. So let's break down the phases again, just to be clear. During the construction phase, you get up to those draw amounts and you're making interest-only payments based on the 12% construction rate. Once everything's complete and you've got that final inspection or appraisal, the loan flips to the second phase, a standard 30-year fixed at 8.5%. So now, instead of high payments, you're making regular principal and interest, plus your taxes and insurance are usually escrowed in the payment. So you're not getting surprise bills twice a year. By the way, if you don't use all the construction interest, they actually refund what's unused at the end, which honestly is kind of rare in lending. And look, speaking from experience, before I started using structures like this, I was trying to coordinate 3 different closings. A bridge loan here, a perm loan there, different sets of fees. One time I literally had to delay a closing because the bridge lender's docs weren't ready. And I kid you not, someone forgot my file at home. If you can avoid those messes, do it. Rehab-to-Perm definitely helps. All right, let's zoom out and talk big picture. What does this actually mean for investors? There are some real headline benefits here. Single closing, for starters, one underwrite, one pile of paperwork, and you're done. That's huge for time and money. Second, and this is crucial, predictable long-term rates. You get on day one what you'll have for the next 30 years. So even if rates jump like we saw after the pandemic lull, you're not scrambling. Third, easier qualification, because lenders are underwriting both you and the property's future value upfront, not crossing their fingers that you'll qualify for a new loan in 6 months. Fourth, flexible draws. You only pull construction funds as you need them. So interest costs are tied directly to your project progress, and you're not paying for money you're not using. And last but not least, you end up with a property that's ready for rental. Income starts rolling in, and you're not wasting time on overlapping closings. Now, let's talk about the fees, because that's what everyone really wants to know about. In the Michigan deal, for example, it was a 2.75% origination fee with a $2,750 minimum, plus $650 in underwriting and processing fees, construction interest escrow around $1,294, and about $34,844 cash needed at closing. Obviously, taxes, insurance, and any closing costs get escrowed on the side. So keep that in mind when planning your capital stack. And look, I get it. There's always a trade-off. Upfront costs can feel steep, but you're paying to eliminate rate uncertainty and for the simplicity of one closing. For a lot of investors, that reliability has real value, especially if you're building a portfolio and need to move fast. On the flip side, some folks might prefer to piecemeal it. Try to nickel and dime across multiple loans, hoping to save on fees. I used to try that, not sure it was worth the extra stress. Bottom line, if you want something streamlined, predictable, and ready for rental cash flow as soon as the renovation's done, Rehab-to-Perm loans are hard to beat. But every investor's got their own risk, tolerance, and style. All right, that's a wrap for today. If this sparked some questions or you want to talk options, you know where to find us. I'm always happy to chat deals. We'll keep digging into more creative and efficient financing strategies in future episodes. Catch you soon.